Welcome to the Life Self-Mastery Podcast, where we bring in entrepreneurs who have created online businesses and improved their lifestyles. Here's your host, Rohit Malhotra.
Hi everyone, this is Rohit from Life Self-Mastery, and I'm excited to have Anirudh Damani, who's the founder of Artha Venture Funds. Artha Venture Fund is a 33 million early stage capital fund that will invest into 45 seed stage companies falling in pre-Series A, Angel, and Series A rounds. The investment strategy is built on experience. Anirudh has gained from investing in 55 companies, participating in more than 100 funding rounds, and delivering top quartile results. Anirudh has been an investor in companies like OYO Rooms, Exotel, Tala, NowFloats, Purplle, and many others. Anirudh has done his bachelor's in business administration from Boston College. Welcome to the show, Anirudh.
Thank you very much, Rohit. Thank you so much for having me on the show.
Awesome. So Anirudh, how did you get into the early stage of angel investing, and then why did you go on to build your own VC fund?
So I think the founders that I like are the ones that have a personal pain point that makes them want to open a business to solve that pain point. And similarly, me getting into early stage investing came from a very personal pain point. I was an entrepreneur in the US, and I built and sold an energy company over there. And when I moved back to India, I wanted to initially get into the same business, but opening up a business in 2012 in India was an extremely painful process. It completely opened my eyes towards how Indian entrepreneurship was, different as night and day from US entrepreneurship.
Right.
And the idea came to me that if it was so difficult, I'm a fourth generation entrepreneur in my family. I have a pretty storied family background in entrepreneurship. And if it was so difficult for me to open up a business in India, then how difficult would it be for somebody who has no experience or no background in entrepreneurship? So the idea then came to me that, if I could put in a bit of money into these early stage companies, but also help them a lot more with my time capital and with my experience capital, right? And help almost sort of co-develop these ventures, there could probably be a lot of personal satisfaction and a lot of money to be made, right? And so the idea then came to me that, if we should get in first, we should be there early, put in a bit of money, give them a lot more time, handhold them, and then just see them soar. And that's done pretty well. In over 7 years, after almost 60 investments, we had category leading companies like OYO, Exotel, Tala, Purplle, and NowFloats. All of which went on to do very well. And then after about six and a half years, when we were just looking back at our portfolio and all the people that we were working with who were co-investing with us, the idea came from our co-investors that why don't you set up a fund? And we will support you by putting in, by being your first LPs.
Right.
But for me, it was very important because as a family, we've not taken even a business loan in the last 70, 80 years of being in business.
No.
So I went, around the world. I spent a lot of time understanding different, fund structures and why some worked, why some didn't work. And I came back with the intention that I wanted to do something that would make it possible for me to return money to investors, my LPs, without requiring billion-dollar exits for that to happen, right? So I came up with a structure where we would be a small fund, 30 million to 33 million,
Right.
and we would own a larger or have a higher ownership in our investee companies, right? So we typically would own between 25 to 30% in our investee companies. And we would also be relevant for them over 3 rounds. So instead of just writing a single check, we would write follow-on checks that were larger and bigger. So a lot of our fund would be for follow-on investing. And that would essentially create a win-win situation for the founder, because he would not have to keep going out there and looking for outside capital. It would also create a win-win situation for us, because it would allow our LPs to see our portfolio and understand and also be able to co-invest in future rounds. And for us, it would help us hone in our energy, right? We would know exactly which companies are doing well, and in follow-on rounds, write larger checks and get meaningful return for our time capital by having a larger ownership stake in our companies. And the way we see it is that as long as we hold 20% of a $150 million company, we return the size of the fund. So we don't need massive winners to return money back to our investors. So win-win-win for everybody.
Interesting. So, I wanted to understand, what is your portfolio construction? Are you sector agnostic, or do you focus on only particular sectors for now?
So we're a thematic fund. So we're not looking at sectors. We look at three specific themes. We invest in Indian consumption. So we invest in anything that enables that consumption, and then we invest in B2B. Now, the difference between thematic and sectoral is that certain things could fall into certain sectors, but it could fall into multiple themes for us. So a particular company, like in logistics, might also be a consumption enabler and be a B2B company if it's in last mile, right?
Right.
So therefore we look at themes thematically, because I think themes also play out over a longer period, like a 7 to 10 year kind of period, versus sectorally, as you can see, sectors come and go like as soon as 2 years these days, right? So there's a recession and an expansion in a sector within a matter of a couple of years. So instead of getting in at the high and then having to see significant write downs, we'd rather get into themes which have a much longer play out period.
Correct. And this is your first time fund. How did you look at raising funds for Artha Funds? Are most of your LPs domestic, or are you also looking at international LPs who could invest into your fund and your fund which you're about to close right now?
So what we did, Rohit, was I think it was very important for us that we had support from domestic LPs before we went global.
Right.
Going globally and explaining the opportunity would be very difficult, because if they asked you who's supporting you back in India, and you would say hardly anybody. So how it become a very difficult conversation to have with global LPs. Right. So what we did was, our first two closes, which was up to 100 crores, we raised almost 90% of that domestically.
Okay.
Now we are at about 125, 130 crores that we've raised so far. And the participation from global LPs has been going up steadily. So now 80% of the capital is committed by domestic LPs and 20% by global. And I think by the time we get to our target size of 200 crores, we probably have about a 70-30 kind of a ratio.
Correct. And I also read that you're looking for other micro funds, which are sectoral funds, where you're looking to raise funds. Would you look at changing or improving while raising for other funds, or are you going to focus on raising the main fund and then looking at investing into raising funds or other sectoral funds later on?
No, so actually we're not looking at raising funds for other micro VC funds. The idea here is that we're trying to create a fund house, right? So not right away, but eventually the idea is that we'll have multiple fund managers operating under one entity, and everybody having their own micro VC fund. Sure. So we can attack different parts of the market and different sectors or different themes, and yet have individualistic performances. I think it's a very India-specific solution that we've typically, as VC funds in India, not had a lot of funds that have seen 4, 5, 6, 7 different partners. At certain sizes in India, most funds disintegrate and fund managers break out and set up their own shop. So so what we wanted to do was we're trying to solve that problem as well. That how do we keep everybody together? But and I think that comes from making sure that everybody is demarcated, separate funds, and but we all operate as one, so that there is strength in numbers, but separation in terms of how everyone performs, right?
Right, correct. And also, when you talk about your portfolio companies, you've invested, personally and also through the fund in a lot of women, led founders, especially like Tala and other companies. Do you think it was a conscious decision from your end to invest into founders who are female, or do you think going forward you're focusing more on the merit of the person rather than focusing whether they're male or female, because as the industry statistics show that women get only 2 to 5% of the VC funding, or even at follow-on funding. Do you think that is something which is bound to change even in the Indian ecosystem?
I think that change is coming, right? I think you're seeing a lot more female participation even at the fund side, right? So obviously you've got Vani over there who's managing an excellent fund at Kalari, but other than that, I think even so in our current fund, right? And I'm talking about the first 6 investments. 4 out of the 6 investments have a female founder, right? So 2/3 of our investment has gone into female founders. And I'm looking at my upcoming pipeline, the next 5 investments, I believe 3 of them have a female founder. 2 of them have them as CEO and founder, right? Now, is it a conscious decision for me to back female founders? Absolutely not. I don't believe in putting a gender tag on any founder.
Right.
For me, it's most important that we have good founders, whether they are male or female or otherwise, it does not matter to me, right? And I think it's just an happenstance that because we attract good founders, because we have a lot of female founders already that we have invested in. So like besides Tala, we've got Carve, we've got Inc42, we've got BabyChakra, and obviously Dalchini as a CEO and co-founder. I think just because there is already so many female founders that we back, there is probably a name out there, that if you're a female founder, you should be approaching Artha Venture Fund.
Right.
But for us internally, we never look at the fact that a founder is female or male for the reason or as a part of our decision making. So we're not trying to meet any ESG guidelines by investing in a certain portion of female founders. It's just that we invest in good founders. We invest in passionate founders, and it's just that there is a lot of passionate founders that we found that we've invested in, and that they happen to be female.
Interesting. So, Sequoia is one fund which looks more into the team when they're looking into investing into a startup, but what is your framework when you look at investing into a startup? Is it the team or the total addressable market or the idea? What really excites Anirudh?
I think initially, because and I'll talk about maybe on a per round basis, right? When we're investing at seed, right, we're always looking at the team, because anybody who's been in VC would know that early stage companies pivot, and they pivot a lot, right?
Correct.
So,
yeah.
For us, what's important is that it's a strong, cohesive team. They have a lot of passion for the space they're in, and we really love it if there is a personal pain point that they are trying to solve, right? Because that just makes them go above and beyond.
Right.
Putting in the pre-series round, we're typically a little bit beyond the team. We're looking at whether the unit economics are making sense, is there product market fit, is there ability for the venture to scale, and will this money act as a leverage for it to achieve a pole position in their specific vertical or specific category. And then the third round, which is the series A round, where we don't lead the round, but we write a significant check. Obviously, that is your growth round, right? That's after you've proved that there is positive unit economics. You've proved that the team has the ability to recruit, that there is enough scale coming in, there's enough growth coming in, and you just need the money now to put a leg up, right?
Right.
So each round has its own reasons, its own decision making criteria, but everything starts from the team, right? And then for us, if we don't like the team, or we don't believe that the team has their incentives in the right place, then that's probably not going to be something that we're going to invest in.
Correct. And this is for the founders who are listening to this podcast. What advice would you give to founders when they're looking into selecting the VCs? Because this could be a 10-year journey and relationship. Obviously, you would want the highest quality entrepreneurs to have a relationship with Artha Funds. But what advice would you give to founders when they're looking at selecting a VC for the next round?
So a funny anecdote. I was recently a panelist in a conference in I won't give the city because it'll give out the name of the conference, but I was recently in a conference and on a panel, and one of my co-panelists said that, the way he chooses his founders is by doing what's called a pickup phone test. Which what he means by that is that if a founder's calling him, right, and he looks at it, when he picks up the phone and sees the person's name, how he feels about that person calling is how he decides whether he wants to do business with that person or not. So if he picks up the phone and he's excited to pick up the phone and talk to the guy, then that's a guy he wants to do business with. But if he picks up the phone and he goes, oh man, this guy's calling again, one of the criteria not to invest in the guy. I think the founders should have probably a similar criteria, right? I think they should look at it saying that if I was in trouble or if I needed help, right, who's the first person I'm going to call besides friends and family, right? And if that person is not your VC, and again, I'm talking very much in an early stage sense over here. Right. Then that's probably not the person that's right for your business, right? And the right person to take along on the ride, right? So I think that's it's a similar test. I know it's very subjective in this case, but if you get an early stage guy on and he's owning a part of your baby, right, shouldn't you at least want to be reaching out to them when the baby has a cold, right?
Correct.
I think that's what it is.
Right, absolutely makes sense. And my following question is about OYO Rooms. I've been part of OYO Rooms, but what were you thinking when you wanted to invest into OYO Rooms? Because it was a very different, a very new concept. Now, obviously, the product market fit has happened, and it's a big win for the Indian ecosystem. But what made you invest into Ritesh and OYO Rooms?
No, Ritesh is all passion, right? I mean, 18 years old at the time, gave up his college career, gave up, in fact, when he got the grant from Peter Thiel, invested all of that money into his company. Right. So here was a guy who was willing to put everything on the line, right?
Right.
And he's a Marwadi, right? He's a Agarwal after all, and in that community, right? Not finishing education is a big problem, right? So if somebody is willing to put their entire life on the line and they're so passionate about solving a particular problem, it would be a travesty if as a VC we did not invest into that founder. So according to me, while I knew what the space was, and there was a big, even before he did OYO, there was something called Oravel, which was sort of a corporate Airbnb model that he was going after. It didn't matter. I think even if he said he was going to sell lemonade on the side of the street, the passion that this guy had, if I wasn't investing in that kind of passion, then I shouldn't be in the space.
Right. Makes sense. And, what do you think about, company failure and postmortems, especially, after what has happened with WeWork and there have been a couple of failures. How do you judge at a portfolio company which is failed, and what message would you give to a founder who wraps up his company?
Yeah, the key thing is, not every failure is bad, right?
Right.
What is important is that when you fail fast, right? Don't try to, a lot of the times people want to just hang on to a business as long as possible, even though they internally know that the business is not working out, right? Don't waste your time. If you know that the business is not working out, it's better to just take a write-off and move on, right? And it's happened to us, right? We've had businesses and I guess we've imparted some of that knowledge to our founders, because most of the times the write-offs in our portfolio, and we have almost 16, 17 of them, have all been seed round write-offs, right? There's only one or two companies that raised a follow-on round and then have shut down. Now, the reason for that is that, we're very clear from the very outset when we get in that what are the metrics that are going to define that this business is doing well or not, right? And if you feel that the business at the outset, is not meeting the metrics that would justify the founder spending more time on it, or our money spending more time in the company's bank account, if those things are not getting justified, then it's best to move on. And I think that is what failure is all about, right? In startups, you're going to have 90% failure, but the point is, can you get to the failure fast enough so you can innovate and go on to the next opportunity, right?
Right.
And sometimes, Rohit, and to just add to this point, is that not all failure is equal to company shutting down. Sometimes you have to fail at a business model or a business strategy before you move on to the next strategy, right? And so the company could still survive. The company could still go on. But if you spend too much time or too much effort behind the wrong strategy or the wrong model and not willing to pivot, right, that could also be the end of your company. That probably is the number one reason why most companies in our portfolio fail, is that they knew that the things were not working and they decided not to pivot, right?
Right.
And I think, which is why I say, when you fail fast, you'll still have some money left, some bandwidth left to go after one more, to go at it one more round. But if you wait too long, then you're exhausted, the money's not there, motivation is completely down, the momentum is no longer there, and then the company is going to shut down, right? So failure is not just about the company shutting down, it's also about understanding when to pivot.
Makes sense. And, you talked about investing into P2P startups. I was wondering, what sort of metrics do you ask your founders to focus on? Is it the ARR or the CAC payback? Can you talk about some of the metrics which are important for B2B startup founders to focus on?
Are we specifically talking about P2P lending or P2P like an overall?
B2B startups or
B2B. Sorry, okay.
Right.
No, so for me, I think B2B is very important that the company should make money from every transaction level, right? I think India offers one of the best, I guess, petri dishes for B2B companies that want to scale to the globe. Now, the reason I think is because India is a very price sensitive and a very hyper competitive market. So if B2B companies do well in India and they can scale their operations across the country, and we're in a country where every single state has a different language, where many states have written languages that don't even compare to each other, right? So what a person from Punjab would have a difficult time reading Bengali, and a person from Bengal would have a difficult time reading Kannada, right? If we can have a B2B company that scales to this country, their technology and their processes would be so robust, they could actually go to the globe. Right. And we've seen that in our B2B portfolio personally, right? I mean, companies like Exotel that are seeing much higher realizations when they go abroad. And also because they have scaled across the country, they find it much easier to scale abroad because their technology, their processes are built for different languages, for different, even written prose, right? And so I think B2B companies, we look at the fact that they have positive unit economics, that they are scaling, they're growing, that the target group that they're going after is big enough, and whether they have an opportunity to go global at some point, right? And that's what really gets us excited about B2B companies from India,
No, absolutely. When you look at B2B companies like Zoho, Exotel, and other SaaS companies who are also expanding to US and Europe. And, my following question is, when does a founder know that he needs to expand into other regions, like what OYO and Zomato and for that matter, Freshdesk has done? When do you think a founder should look at other regions to expand his market?
I think if a founder has been able to expand to at least 10 states in India, right?
Okay.
And has done well doing that, then he should try to expand to another country, probably even trying to go through the Indian diaspora in these other countries, right? And I think Indians, just being entrepreneurial as they are, have been entrepreneurs across the globe. So, reaching out to that kind of a diaspora and then seeing if they can capture that market, probably a good metric to start. Again, every company is different and every situation is different, but if I had to just put a quantitative number on it, or quantitative way of doing it, then I would say scale to 10 states. If you're scaling well and you're making money, then go abroad.
Correct. And who would you credit as having the biggest impact as an investor? Artha Funds have been backed by Mr. Ashok Damani and Ramesh Damani, who your father and uncle. Whom would you credit as having a biggest impact as an investor, and what did you learn from Mr. Ashok Damani and Mr. Ramesh Damani?
So both my uncle and my father are stockbrokers, and they've invested. They've been investors for almost 40 plus years now. Right. So I think a lot to learn. I think I grew up even at the dinner table listening to stock prices and how certain people are doing well and not doing well, and how certain investors even like Radhakishan ji or Rakesh ji and even my Nana Kamal Kabra, how all of them had, strategies around the fact that you don't throw good money behind bad money, right? So you have a cutoff and you have a downside to your thesis, and when it's not working out, you exit and you move out.
Right.
And I think all of that influenced my life, right? I think my father has a philosophy that after you buy a stock, don't look at the share price, and after you sell a stock, don't look at the share price, right? So,
Right.
so I think that really helps, right? Because when you buy something and you immediately start trying to figure out what's the value of my holding, right? You spend more time trying to do that than actually trying to help the business. And a lot of the times when you've sold and the business does well after that, then you spend a lot more time worrying about, the FOMO aspect of it, and then trying to build, find the next idea and making sure you don't make the same mistake again.
Right.
So from them, I've learned just the value of, or the art of how to hold on to your winners and how to cut your losses. And those lessons have come from obviously them being associated with so many marquee investors in India. And yeah, I'll credit them for giving me access to that kind of experience and knowledge.
Interesting. And Anirudh, are you concerned with the excess capital which has been raised by founders in the last couple of years, especially in the Indian ecosystem? And what advice would you give to founders for capital efficiency?
It really depends, Rohit. Sometimes we advise founders to raise more capital than they need,
Right.
because also capital can act as a moat, right?
Right.
And sometimes, so if you have excess capital, I think the most important part is not go after things that are far away from your core business model, and also not try to use the additional capital for things that are beyond the business plan. It's sometimes okay to just leave the capital inside your bank account and just earn the interest off of it, until unless you've got a compelling opportunity that either that is going to beat the IRR that your current business is already offering, right? And if that's not happening, then let's not just use the capital just for the sake of it.
Got it. And do you think the Indian startups are more into there going to be a lot more M&A deals, or do you think in coming 5 to 10 years there are going to be a couple of IPOs? Because I think Naukri is the last big IPO we've had, and that's been a decade from now. But do you think India is still a M&A market?
I think for the foreseeable future, yeah, India might even see some reverse mergers at some point. But I don't essentially think that the Indian IPO market is ready for startups, right? Because a lot of these startups, because of the market that they're going after, because of the business that they are trying to capture, will see a long period of losses, right? On the balance sheet level, right? And I don't think the IPO or the retail investment in India is ready for that. But however, I know a lot of the top corporates in India, and if I could just take the top 100 corporates or top 500 corporates in India, they've all set aside money to invest either into startups directly or to acquire startups. And I think that really is going to fuel the next leg of exits for early stage investors.
No, absolutely. I think if the Indian corporates, they're able to help out with startups, and there are a lot more exits coming up to legacy businesses, I think that's going to be very interesting in next coming years. And so do you have any latest investment that you've made, and any reason why you've made the last investment you've made?
So actually, it's been about 4 or 5 months since we have made an investment.
Okay.
Thing is that we're in due diligence for 2 investments right now. Another 3 are just about to go to the investment committee for their approval.
Sure.
But yeah, the last investment that we made is in a company called Everest Fleets, which is Uber's largest fleet manager in India. And the reason we made the investment is, I think, what I really liked is that Siddharth, who's the founder of the business, was looking at sweating out physical assets like a car by using drivers, but putting 2 drivers per car. So ensuring the car is running 24/7, and that would offer Uber much better supply and also ensure that Siddharth was paying EMI once, but making the asset work twice, right? Which to a Marodi like me always makes sense, right? So
Right.
that's the reason we backed it. They're using technology and using processes to ensure that the cars don't have to come back to the office. The cars are always running. So, and they use technology to ensure that the cars never have to come to a central meeting point, right? And because of their size, they're almost at 700 cars today. They're getting much better pricing for their cars. They're getting much better pricing for their repairs and maintenance, and so on and so forth. And that itself becomes a self-fulfilling prophecy, because things are only getting better as they gain in size. And hopefully, over the next couple of years, we'll see them at about 10,000 cars, and have a dominant position in the urban mobility market.
Got it. We'll put that in the show notes. I quickly want to do the top 3. What's your favorite business book?
Favorite business book? I would say Shoe Dog.
I love that book. And if you could go back in time when you started working on Artha Funds, what is the one thing you would done differently?
I think I would have hired more experienced people much faster than I did. If I had brought in better talent earlier, I would have probably scaled faster.
Got it. And do you have any favorite online tool like Gmail, Slack, Zoom?
Favorite online tool? If I can give you a personal favorite right now,
right?
So I'm using this online scheduler called X.ai.
Awesome.
That's really helping schedule meetings in different time zones, and also is freeing up my EA. I think that's a tool that definitely I'm really excited about right now. But overall, if you ask me from the beginning of time, a tool that I like a lot is OneNote, which is my go-to app for taking notes.
Got it. Yeah, this is the first time somebody has mentioned X.ai. What is the best way people can reach out to you and get to know more about Artha Funds?
Are you talking about as a founder?
Yes.
As a founder, the best way to reach out to us is find somebody that knows us, that knows in my network, and get them to send us a referral. We do not accept direct deals. I think if you're a founder, that's the best way. And if you're an LP, you can always, there's multiple ways to reach out to me. There's Twitter, there is LinkedIn, and my, the company website.
Got it. We'll put that in the show notes.
Reach out to you, and then you can connect us.
Yeah, that can also be there. Right. Anu, thank you so much for taking our time and speaking to us. Really appreciate speaking to us.
Thanks so much, Rohit.
Thanks for listening to the Life Self-Mastery podcast, where we teach you how to start and grow your online business. For more information, visit Rohit's blog at www.lifeselfmastery.com.